Today we're breaking down real monthly dividend payers you can invest in, and how to build a portfolio that could pay you €500 per month. No fluff, straight numbers. Let's get into it. First, what even are monthly dividends? It's simple. Most companies that pay dividends, like Apple or Coca-Cola, do it every 3 months, which is called quarterly. But some stocks and many exchange-traded funds or ETFs pay out every single month. This gives you more frequent cash flow, which can be great for budgeting or just feeling that your investments are working for you more often. The key thing to remember is that dividends are never guaranteed. A company can always decide to reduce or cut them, especially if business is tough. But for now, let's look at who's paying. So, where can you find these monthly payers? Let's start with individual stocks. They've been paying monthly dividends for decades and currently have a dividend yield of around 5.6 to 5.7%. They're a real estate investment trust, or REIT, that owns thousands of commercial properties. Another one is Gladstone Commercial, ticker GOOD. This is also a REIT, and it's known for a much higher yield, recently around 11.5%. A third example is LTC Properties, ticker LTC. This is a healthcare REIT focused on skilled nursing and assisted living facilities, a stable niche that supports its monthly payouts. And finally, Agree Realty, ticker ADC, is a retail REIT that also offers that monthly dividend exposure. You will notice a pattern here. Many individual stocks that pay monthly are REITs or another type of company called a business development company, or BDC. It's famous for its monthly payouts and has historically offered a double-digit dividend yield. Its cousin, the JP Morgan Nasdaq Equity Premium Income ETF, ticker JEPQ, does something similar but focuses on Nasdaq stocks. It also pays monthly and has a yield that has been hovering around 11 to 11.7%. An older player in this space is the Global X Nasdaq 100 Covered Call ETF, ticker QYLD. It's been paying monthly for years and also has a yield around 11.5%. And for those looking for lower volatility or broader global exposure, you could look at ETFs like SPHD or Global X's SDIV. There are plenty of options out there. Now let's have a no BS talk about how dividend yields work. A key point is that getting paid monthly doesn't automatically mean you get more money than someone getting paid quarterly. Also, a super high yield is not a guarantee of safety. Often, it signals higher risk. It's a valid strategy, but it's important to know where the money is coming from. It's not pure company profits being shared. So, let's model out how you could get to that goal of €500 per month. €500 a month is €6,000 a year. The amount of capital you need depends entirely on the average dividend yield of your portfolio. If your portfolio has a blended yield of 5%, you'd need €120,000 invested to hit that goal. If you can achieve an 8% average yield, that number drops to €75,000. And at a 10% yield, you'd need €60,000. Let's imagine a hypothetical blended portfolio. Say you invest €90,000 in total. You could put $30,000 into JEPI, which has around a 10% yield. That would generate about €2,500 a year. Then you put another $30,000 into QYLD with its 11.5% yield, generating around €3,450. Finally, you put the last 30,000 into a basket of REITs like realty income, averaging about a 5.7% yield. That's another 1,710 euros. Adding it all up, your 90,000 euro investment would generate about 7,660 euros per year, which is around 640 euros per month before any taxes. Of course, this is just a hypothetical example. Markets and yields fluctuate constantly. And that brings us to the risks and the reality check. There are no guarantees in investing. Dividends can be, and are, cut. A high yield often means higher risk. That income might be coming from option strategies, as we discussed, which have their own complexities, or from businesses in challenging sectors. And remember, taxes are a big factor. Depending on where you live and the type of account you're using, your dividend income will be taxed, which reduces your take-home amount. Also, all the yield numbers I've mentioned are estimates based on recent data. They change daily with the market, so always do your own research. So, what are the actionable steps? First, decide on your personal risk tolerance. Are you more comfortable with the stability of a 5 to 6% yield from a company like realty income, or are you willing to take on the higher risk and complexity of a 10 or 12% yield ETF? Second, choose your mix. You might build a core of reliable, lower yield stocks and then add some higher yield ETFs for an income boost. Third, track your payouts. See the cash flow coming in each month and decide whether you want to reinvest it to compound your growth or withdraw it as income. And finally, review your portfolio over time. The market changes and your goals might too. Real passive income takes capital and discipline. It's not magic, but monthly dividends are a real tool you can use. Pick your strategy, understand the risks, and start building. Thanks for watching. And if you found this helpful, be sure to like and subscribe for more content just like this.